Welcome to Private Asset Management's Week in Review. Today is Friday morning, June 17th. I'm Dillon Hakes. I'm joined by our Chief Investment Officer, David Allen. David, very difficult week for markets this week.
That's right. Unfortunately, for the second consecutive week, a pretty big negative week in S&P 500. The index is now entered a traditionally what's defined as a bear market, and this is set to be likely the worst week that we've seen since March of 2020 in the S&P 500.
A big week on the economic side of things. We've been talking about it last week. We've been talking about it for a while. We had an FOMC meeting this week. They raised 75 basis points. Markets initially reacted positively, went back to negative selling. What did we learn?
The outcome of this week's FOMC meeting was different than what we would have expected just a couple weeks ago. But if you remember last week, we saw both disappointing consumer price index data as well as consumer sentiment data. And that really led to that 75 basis point increase as the Fed really tries to keep a handle on inflation here in the U.S. The 75 basis point increase is very large from a historical perspective. It's actually the biggest that we've seen from the Federal Reserve since the 1990s.
Besides the 75 basis point increase, what else did we learn from the press conference, from the statement that they put out?
So the Fed really took some steps in their communications with the public to reiterate that inflation is their top priority, bringing inflation back down to the 2% target. They added some new lines to their policy statement to that effect, and also went as far as to say that they think that they were less confident that the labor market strength would be maintained through that the fighting of inflation.
What about the Fed's economic projections? What are they seeing going forward over the next couple of years?
On the interest rate side, the Fed is expecting another 175 basis points of interest rate increases this year, followed by at least another 50 basis points of increases in 2023. From year-end 2023 to year-end 2024, they're actually expecting rates to fall by a bit. They also put out some expectations for economic growth, unemployment, and inflation. On the economic growth side, they did revise down their estimates over the next 3 years. Unemployment, they're expecting it to be a bit higher than what they did in their March projections. But they do see inflation still continuing to fall as they did in previous rounds of these economic projections. What
about our outlook? Are we as optimistic?
In general, I think the Fed is still too optimistic in their projections for the economy over the next several years. They're expecting growth to be a bit slower than they did in March, but it's still not that far from the trend growth rate in the economy. They're expecting unemployment to be higher, but still not that far from their long-run projections of full employment in the economy. So though they're expecting inflation to fall pretty considerably, much higher interest rates than what we see right now, moving well into restrictive territory, they're not quite reflecting those conditions in their projections for both the economy and the labor market.
We also got a retail sales report this week. What did we see in the data?
So on the retail sales front, headline retail sales fell by 0.3%. And then we also saw April data revised down. So, sort of at first blush, it seems pretty negative. But overall, if you look at the categories that are going to filter most directly into GDP growth for the second quarter, that was about flat after pretty strong growth again in April. And so the consumer still seems on track to post a growth in real consumption for the second quarter. And it's something that's going to be additive to overall economic growth in the period.
We've talked about this in the past, but it seems a bit like the data that we're seeing is a little bit incongruent with what's going on in markets. The data, retail sales doesn't seem all that bad, but markets are selling off dramatically despite that.
It's important to remember that financial markets are a discounting mechanism. They're looking at risks on the horizon, and they're pricing those risks in today. And so while we're seeing increased recessionary risks here in the U.S., both in some of the hard data as well as survey data of consumers and businesses, it's still far from certain that there's going to be a recession here in the U.S. in the next 12 months.
This year has been a tough year for clients. We've had selling that's lasted the majority of the year. Help us put this in perspective in the context of history and what we've seen in the past.
Right. So putting this downturn into some context, on average, a bear market in the S&P 500, it lasts about 8.8 months. Right now, we're about roughly 7 months into the current downturn. So at least based on averages, perhaps we're coming towards the end of this bear market. Now, in terms of recessionary risk, the average downturn preceding a recession in the S&P 500 is about 30%. And the downturn that we've seen so far this year is approaching that level. So perhaps we're closer to the end than we are to the beginning in this current downturn.
On the portfolio side, how are we adjusting our strategy to the current situation?
Right. So Following the FOMC meeting on Wednesday, we certainly take the Fed's dedication to fighting inflation pretty seriously. We think they're going to be dedicated in that, and that is going to mean higher interest rates here in the U.S. So on the fixed income side, I think that means that we want to keep our maturities short and prioritize high quality in fixed income portfolios.
What about on the equity side? How does this change what type of companies we want to invest in?
We see higher interest rates impacting equity market positioning in two ways. First, we want to focus on companies that have strong near-term cash flows. As rates move higher, further out cash flows are going to be discounted at a higher rate, meaning they're going to be less valuable as reflected in current prices. And so we really want to focus on companies that are generating strong cash flows that aren't going to be impacted by higher interest rates to the same degree. The second point is we want to focus on companies with strong balance sheets. This is something we've said a few times over the last several weeks. As rates move higher, some highly indebted companies who aren't generating strong cash flows, aren't able to meet their new higher interest expenses, could really struggle. So we want to focus on companies that have low debt balances and strong earnings and the ability to cover their higher interest expenses as we move forward over the rest of the year.
What do we have on the agenda for next week?
Well, after 2 weeks of quite a bit of economic data to go through, next week we're expecting a bit less to digest. Two pretty important reports in terms of the housing market, though. On Tuesday, we'll have existing home sales data, followed by new home sales data on Friday. The higher interest rates that we're seeing affect other parts of the markets in the economy. Those are certainly going to come to bear on the housing market as mortgage rates continue to climb.
We'll look forward to that data. Thanks, everybody, for joining us for Private Asset Management's Week in Review. We'll see everybody next week.